there, tax accountants. I hope all is well, and I pray that as you're viewing this video that you're in the best of health and spirit. This video will cover several questions from Income Tax Fundamentals 2025, Chapter 2, which covers gross income and exclusions. In this chapter, there's a myriad of learning objectives. We'll apply the definition of gross income, describe salaries and wages. So there's so many different things to cover. But the main thing to keep in mind is that this chapter is going to start with the definition of gross income. And then there's some detailed coverage for what is included, what Uncle Sam says needs to be reported as income. And then there's also some items of income that are excluded for tax purposes. So we're going to get started with the first question. Here it states the nature of gross income. So gross income, whenever you are preparing a tax return for an individual, this is essentially the starting point for calculating the taxpayer's liability. So the tax law states that gross income is all income from whatever source derived, including but not limited to. So if you have a job, if you have a business, if you have property that you sell, interest, rent, pension. But keep in mind, the definition of gross income, all income from whatever source derived, this is essentially like the most well-known definition in the tax law. So what that basically says, I'm a U.S. citizen. If I decide I want to go and start a business in Guyana, where my family is from, even though it's not within the United States of America, Uncle Sam says, hey, gross income is all income from whatever source derived. So therefore, as a U.S. citizen, I am responsible for reporting all income. So simply stated, unless there's an exception in the law, the U.S. government considers all income taxable. So much like, let's say, if someone goes on a game show, right? So one game show I would love to go on is Family Feud. If I go to Family Feud, me and my family, we win. And let's say we win $100,000 and it's four of us, right? Each of us, we received that 25,000. Guess what? Uncle Sam wants a piece of the pie. So just keep in mind, prizes and awards, cash and non-cash payments for goods. Even if someone and I, let's say as a tax professional, I prepare taxes for someone and I don't know much about cars. So if we barter, we exchange services, Uncle Sam says, hey, even though there was not an exchange of cash, you guys bartered. The fair market value of the tax services that I provided to the mechanic and the fair market value of the services that he provided for me, you need to report that as income. All right. So just keep that in mind. The nature of gross income in the tax law is, it says all cash payments received for goods provided and services performed. No, because what if a client plays with a card? So A is the incorrect answer. B states all income from whatever source derived. That seems correct, but remember, anytime you are working on multiple choice questions, you want to go through each answer choice because you might think that something is the correct answer. There might be a better answer choice. So you want to go through all of them. C states all income from whatever source derived unless the income is earned illegally. Absolutely not. What we are going to come to learn is that even if income is illegally earned, you have to report the income. The caveat though is that you report the illegal income, but you are not allowed to deduct any expenses to offset that income. But I mean, what are the odds that people are reporting the illegal income? But here's why I believe that that's a part of the tax law, because let's say someone is doing something illegal and they're discovered, now Uncle Sam has something that could pretty much, catch the person because, hey, you were making this illegal income and you didn't report it for tax purposes. So now this person is evading taxes, right? So just what I think, could be right, could be wrong. All right. And then D states, lastly, all items specifically listed as income in the tax law. So that's incorrect. It sounds like a good answer, but it's actually incorrect. I mean, the tax law is so vast, right? So if they were to basically list every single type of item, no. So what makes more sense is basically just to have a list of exclusions. So as mentioned earlier, unless there's a specific exclusion in the tax law, the U.S. government considers it taxable income. So B is our correct answer. So here we see it's asking us to indicate whether each of the items listed below would be included or excluded from gross income. So here we, have a number of different items. We have some welfare payments, someone that was incarcerated and they received an award. So as we just pointed out, gross income, this is the starting point for calculating a taxpayer's liability. So we need to know, right, what is going to be included in income and what is going to be excluded. So Here we see welfare payments. So with welfare payments, these are essentially going to be excluded, right? So again, keep in mind certain things are not considered taxable. So generally there are, tables that basically specifies what's included and what is not included. So here we have welfare payments. These are going to be considered excluded. It's not, income. Next we have wrongful incarceration award. So if someone, went to prison because, something happened and they were wrongfully imprisoned, once they receive that award, that settlement agreement, it is going to be excluded from income. It is not considered income. So these are some important things to keep in mind, because there are situations where individual, they receive funds, and then they're like, wait, what? They get a tax form in the mail and they didn't even realize that they needed to report that amount as income. All right, perfect example. Individuals, they get debt written off. I'll never forget, I prepared taxes for my mom, and then one year she received a notice in the mail from the IRS. And I'm like, what? Why, why did we get this notice? Come to find out, some of her debt was forgiven, and they issued what's called a 1099-C, and that 1099-C reports the cancellation of debt, and she did not report it as income. So therefore, again, unless there's a specific exclusion in the tax law, it is considered income. So something to definitely keep in mind. Here we have hobby income. So hobby income is going to be included. So this is basically under the Internal Revenue Code. What they basically state for a business is someone is basically engaging in an activity to earn a profit. Generally, for the most part, when you start a business, first couple years, you're probably, not earning any income. You are spending more than you're making. Uncle Sam has this rule, however, because once you have a loss on a business, let's say you also work a W-2 job or you have other income, the business loss is considered, an active loss. So therefore, the loss from the business can offset income from any other, source. Some people, unfortunately, they take advantage of it. So this was called the hobby loss rule. So in the event that Uncle Sam says, hey, out of the past 5 years, you did not have income, or you claim losses for 3 out of the past 5 years. In such case, Uncle Sam can probe a little bit more, and instead of treating it like a business, they're going to treat it as a hobby. So you don't get to claim the full amount of the loss ultimately. So hobby income is going to be included. This is something very important to keep in mind for students. D, scholarships for room and board. So when you receive scholarship to attend a college and university, anything related to qualified educational expenses, those are, not considered taxable. However, if a portion of your scholarship covers room and board and any expenses that are not directly related to your tuition, unfortunately, that is going to be included in income. So for those of you that are potentially considering getting a scholarship, this is something to keep in mind, because when you receive that form 1098-T, any amount that is allocated to room and board is going to be considered income. Here we see we have $300 set of golf clubs, an employee award for the length of service. So there are some specific nuances as it relates to service and how long you've been working at the company, whether or not that amount is going to be included in income. So certain prizes, certain awards are not necessarily subjected to taxes. So this would kind of tie into like the employee benefits essentially. So when you're working for a company, sometimes, again, depending on how long you've worked at the company, sometimes these things are not considered taxable. So something important you definitely want to keep in mind. Here we have, oh sorry, $300 the set of golf clubs. So in such case, again, this is going to be considered excluded. All right. And this the special rule for that, when it relates to, prizes and awards. So this falls under prizes and awards. So winnings from a television show, radio show, as mentioned, I would love to go on Family Feud one day, right? These things, they are going to be considered income to the taxpayer. And in general, most other awards are taxable. So even if, let's say, like lotto, right? Of course, you win the lotto, even when it's like those small little scratch offs, you still, technically need to report it. You get what's called a W-2G for gambling winnings. There is an exception, however, provided for certain employees when they receive achievement awards, and it can be in the form of tangible personal property. So maybe, employee, they'll get a gold watch for their years of service and things of that nature. If the award is made in recognition of length of service, how long they've worked at the company, then in such case, the value of the property, it can be excluded from income. So generally, the maximum amount that's excludable is $400. But if it's what's called a qualified plan award, then the maximum exclusion is increased to $1,600. So, these are some nuances, some things to keep in mind. This is one of those like special provisions within the tax law. So generally, prizes and awards are considered taxable, but the exception is for certain employee achievement awards in the form of the tangible property. And in this case, they gave a tangible property, which is the golf clubs. They're worth $300, and the maximum amount excludable is generally $400, unless it's a qualified plan award where the exclusion is increased to $1,600. Next F, we have non-employee compensation. So this is basically, you are an independent contractor. You are not an employee of the organization. Yes, it is going to be included in income. As mentioned with my mom's situation, you get that debt canceled. Uncle Sam says you are going to include it in income. I would think that their thought process is, hey, if you had the money, you would have paid off the credit card debt. So therefore, it is required for you to record that amount as income. H, accident insurance proceeds received for personal bodily injury. So in this case, this would be excluded. Inheritances, right? If someone left something behind for you, this would be excluded. Gifts would also be considered excluded. And then lastly, tips and gratuities. So if you work at a hair salon, if you work at a restaurant, tips and gratuities are considered taxable income. So again, the general definition for gross income is all income from whatever source derived. And unless there is an exclusion within the tax law, you can just basically, look at it as Uncle Sam considers it taxable. So something to definitely keep in mind. And this is a great, point when you are dealing with clients. So that way, they get a better understanding. So certain things, I remember a client asked me, their mom passed away. They received life insurance proceeds and they asked if it was taxable. I said, well, it depends, right? So if you just receive the lump sum of the life insurance payment, then it's not taxable. There's an exclusion in the IRS tax law, but in the event that they receive a series of payments, not lump sums, then it's something a little different. A portion of it might be taxable. So definitely important to know. I mean, you're not going to know everything, but again, you always have the publications, you have the Internal Revenue Code and other valid resources that you can use to research to confirm whether or not something is included in income. All right, so here we see it says K will recognize how much gross income on this exchange. K Neen is a dentist and provides Rusty Clutch with $800 of dental services in exchange for Rusty repairing K's car. How much is K going to recognize? So again, you might say, why am I including this for income? We just exchange services. Uncle Sam says absolutely not. So 0, A is not the correct answer. B states the market value of the services exchange. It seems like the correct answer because this is basically bartering. C states the out-of-pocket cost of the car repair parts. And then D states the out-of-pocket cost for the dental work. No. So barter income is considered gross income at the fair market value of the exchange. So therefore, in situations like this, Uncle Sam says, hey, you're going to need to report it. So there's no way, I mean, there's no real way for Uncle Sam to know that this exchange took place. And one thing you're going to come to, realize with taxation, they are voluntarily, with the exception of, a W-2 and other tax information forms that you receive, they are relying on you to tell the truth on a voluntary basis. And some people do, some people don't. But hey, in the event that, let's say, K-Neen, is audited, or Rusty Clutch is audited, this is a way for them to come and to, further penalize them, because they'll say, hey, well, the tax law says that barter income is considered income and you didn't report it. So now this individual is considered to have evaded taxes. So this is just something to keep in mind. Here we see it asks annual wages subject to income taxes are reported on. So as it relates to annual wages, this is reported. It says Form W-4, we have Form W-2, and then we have Form 1099-W. So it's very important to know what the forms actually look like, so that way, you have a better understanding of what the form is. So I'm going to pull up a Form W-2 so that way we can see what it looks like. And then the Form W-4, so we're going to look at all of the different forms that are reported here, so that way you just get a better understanding of what they are for. So as it relates to Form W-4, this is the first answer choice. So Form W-4 states the employee's withholding certificate. So what this Form W-4 is essentially when you get a job, this is one of the first documents they'll give you. Why? Because this represents how much federal taxes are going to be withheld from the employee's paycheck. So as you see here, step 1, you enter your personal information, name, social, address, your filing status, single, married, separate, married, filing joint, etc. And then step 2, this is essentially if you have multiple jobs or if you're married and your spouse also has a job. Step 3, if you're going to be claiming a dependent and any other credits. And then step 4 is optional. So what this basically states is that, if you're single, you don't have multiple jobs, you don't claim dependents and other adjustments, the IRS is going to basically use that information to determine every time you get paid, this is how much is going to be taken out of your paycheck for federal income taxes. So this is something important to keep in mind, because a lot of times you'll file a tax return for people and they say, they took out so much taxes. Why is my refund so low? Or, why do I have a balance due? What people fail to realize is that all of the taxes that are being taken out are not just federal taxes. You're also subjected to Social Security taxes, which is 6.2, 1.45% for Medicare taxes, depending on the state that you live in. I live in New York City, unfortunately, so I'm subjected to New York state taxes as well as New York City taxes, right? So ultimately, all depends. So all of the taxes that are being taken out from your paycheck, they go to a number of things. So again, W-4, this represents how much federal income taxes are going to be withheld from your employer, and your employer is responsible for remitting it to the IRS, pretty much. All right, then we have Form W-2. So with Form W-2, this is essentially where all wages and income is going to be reported. So I'm going to open this now from the IRS. So here we see, this is basically if someone wanted to, like complete a fillable W-2. So if you scroll down, this is basically what it looks like. It has the employer's identification number. So it's basically like a social security number for a business, a way to identify them. The employer's name, the employee's first name, last name, their address. And then here we see we have these boxes from boxes 1 to 20. Boxes 1 shows wages, tips, other compensation. Box 2 shows federal income taxes withheld. Then we have Social Security wages, Medicare wages, Social Security tips. So depending on your situation, maybe not all of this information is completed. Sometimes I'll see I've in my profession, I've been doing taxes maybe for like 14 years. I can't think of any time I've ever seen a W-2 with box 11, but it's there because it applies to certain situations, right? And depending on the state, I know that if the person lives in Florida, I don't anticipate to see anything in box 15. Florida doesn't have, taxes, well, income taxes, right? So there's certain things that you'll come to know, but this question is asking us in specific, annual wages subject to income tax are reported on. So one thing that we're going to come to learn is that sometimes boxes 1, 3, and 5 are going to be a little different. Don't be alarmed, especially for those of you that, decide you want to specialize in taxation. Sometimes the numbers are a little different. And the reason why is because there are things that can be done to ultimately decrease the amount of your income that is subjected to taxes. So one thing you can do, you're working for an employer, you can decide to, put aside money for retirement, put money into a 401k. So let's say an individual has a gross salary of $50,000 and they decided to invest, to put away $10,000. So box 1 is going to show $40,000, which is taxable, and boxes 3 and 5 will show the full $50,000. And then in box 12A, depending on if they are working for like a government organization or just a regular company, 12A can either be like code D or something like that. And then we'll see the $10,000 that was deferred in income in box 12A. So just the key thing to take away is that boxes 1, 3, and 5 are not always the same. So the correct answer is C on form W2, box 1. And then they have this form. It's asking about a 1099W. I've personally never heard of that form. I will not lie to you. And let's see if it's a real form. It might be made up. That is not a real form. Okay, so I guess that was just a trick. All right, so 1099W, I don't know. I've never heard of that form. So just keep in mind, key thing, boxes 1, 3, 5, W2 might be different. That's the reason why. So here it's asking us life insurance. It states Mbaku's gross income for the life insurance is Lupita dies in 2024 but has a $1 million life insurance policy that lists her spouse Mbaku as the beneficiary. Mbaku elects to receive all $1 million in a lump sum and spends $200,000 immediately on a new yacht. All right, so in this case, you might say, what? He took this lady's money and he's spending it on a yacht. Hey, life insurance proceeds based on tax law, it's excluded from gross income. This is basically based on a premise that it's going to be inappropriate, right? That in a time of need, that the proceeds from life insurance policy, that Uncle Sam is going to subject it to taxes. Like what? But keep in mind, certain requirements need to be met. So Mbaku, in this case, he took the full lump sum. He has the $1 million. Now he has his brand new shiny yacht. Hey, it's lump sum. The IRS says that this amount is not subjected to taxes based on the exclusion. However, if this $1 million was received over a period of years in such case, then it is potentially subjected to taxes. But in this case, $0 is going to be subjected to taxes. All right, so we have another life insurance question. How much of the life insurance proceeds are taxable to Russ? Why? Here it states Sharon transfers to Russ a life insurance policy with a cash surrender value of $39,200 and a face value of $117,600 in exchange for real estate worth $39,200. Russ continues to pay the premiums on the policy until Sharon dies 7 years later. At that time, Russ has paid $17,640 in premiums, and he collects the $117,000 face value. So here it wants us to figure out, all right, well, how much of the life insurance proceeds are going to be considered taxable? So how do we figure that out? So we know that the face value, I'll pull up the calculator. All right, so we see the face value in this case is $117,600. So that represents the full value of the life insurance proceeds. Now, what we also need to figure out is what's the cash surrender value. So in this case, the cash surrender value is $39,200. And then we also factor in, all right, well, how much did Russ pay in premiums? So we add the two, the cash surrender value of $39,200 plus the premiums that Russ has made over the past 7 years, which is $17,640. So this ultimately represents, for lack of a better word, his basis. So $56,840 represents the cash surrender value of the policy as well as the premiums that Russ has paid. So what we will simply do is we add the two and we get $56,840. And we are going to subtract this amount from the face value of the policy. So $117,600 minus the $56,840. The amount of the proceeds that is going to be taxable to Russ is $60,760. All right. So as pointed out, as we saw in the previous example, the life insurance proceeds, they are excluded from gross income. But again, in order to be excluded, the proceeds must be paid to the beneficiary by reason of death. So if the insurance policy is transferred, so in this case, we see that it was transferred. Sharon transfers to Russ the life insurance policy in exchange for real estate. So Sharon didn't die. So in such case, because that it was transferred, either all or a portion of the proceeds from the life insurance policy is going to be taxable to the recipient. So in this case, because there's a transfer of value, the proceeds at the death of the insured is going to be taxable to the extent that one, the cash surrender value of the policy at the time is going to be transferred plus the amount of the insurance premium. So again, the key thing to keep in mind is that the cash surrender value was the 39,200 plus the amount that Russ paid in premiums, 17,640. We subtract that from the face value, and that is why $60,760 is going to be taxable to Russ. And now here it's asking why, right? Someone might say, I thought life insurance were excluded from tax law. Why do I need to pay taxes on this? The policy was transferred. So as the policy was transferred for valuable consideration, the proceeds are not taxable. And correct. The proceeds are taxable to the extent of premiums paid. Sounds like a good answer, but it's not the best answer. Proceeds are taxable to the extent that they exceed the sum of the cash value at the time of the transfer. Yeah, but then also, what about the premiums that Russ paid? So in such case, the correct answer is that as the policy was transferred for valuable consideration, the proceeds are taxable to the extent that they exceed the sum of the cash value plus the premiums paid. So something important to keep in mind. Again, it's not just about tax preparation. As I will tell anyone that wants to specialize in taxation, if you think tax preparation is the way to go, absolutely not. The way that artificial intelligence is just increasing, you really don't need us, right? Especially if it's a simple tax situation, you don't need me to prepare your taxes. But when things get a bit complex, when things get nuanced, right? If Sharon, knew, hey, I'm gonna make this decision, or Russ knew, hey, we're gonna make this decision, before they made it, they will say, hey, let's sit down with a tax professional that can explain to us what the implications are for tax purposes. AI is amazing, it has lots of benefits, but certain things like this, sometimes AI can get it wrong. If you use chat gp at the very bottom, although it's in very tiny letters, it says chat gpt can make mistakes, right? So this is where you provide value as a tax professional. Again, it's not just tax preparation, but you want to be able to provide value to clients by assisting them with tax planning, tax preparation, tax consulting, because again, Sharon and Russ, they can come to you and say, hey, it's going to be $60,760 that needs to be reported, with Russ when he files his taxes. So something to keep in mind. All right, so we have one more life insurance question. So here it's asking, how much should Leah include in her gross income? DeAndre died on July 1st, 2024, left Leah, his spouse, a $65,000 life insurance policy, which she elects to receive at $6,500 per year, plus interest for 10 years. In the current year, Leah receives $8,125. How do we determine that? Right? So again, the general rule is life insurance proceeds are excluded from gross income. However, there's some exceptions. So to be excluded, the proceeds need to be paid to the beneficiary by reason of death of the insured. If the proceeds are taken over several years instead of a lump sum, the insurance company pays interest on the unpaid proceeds, and that interest is going to be considered taxable income. So here we see Leah elected. She wants to receive the payments over time. She doesn't want the lump sum payment. So therefore, now she's going to need to report income. All right. And how much income? So in such case, she receives $8,125. And she elected to receive $6,500. So she received an additional $1,625. Uncle Sam says, wait, hold up. That's an extra $1,625. It needs to be reported as income. So depending on the situation, the person might as well just take the full lump sum, right? So obviously, situations are a little different. But again, if you receive the full lump sum, none of it is going to be subjected to taxes. However, if the proceeds are taken over several years, then they are going to be subjected to taxes. The interest, let me say that. All right, so this brings us to dividend income. So as it relates to dividend income, it is extremely important to distinguish between what's called qualified income, or qualified dividends rather, and what is called ordinary dividends. So the reason why this is important is because they are taxed in different ways. So as it relates to dividend income, this is essentially whereby you have ownership in a company. Let's say, you have stocks in Apple, right? So when Apple is doing really good, what they'll decide to do is, hey, you know what, shareholder, owner, this year we had such, such profit that we're going to share a piece of the pie with you. I mean, it can become a bit nuanced, depending on if you are a preferred shareholder or a common shareholder. But nonetheless, dividends are a type of distribution that's paid to a shareholder or a stockholder by a corporation. And taxpayers, they can receive the following types of distributions from a corporation. It could be from a mutual fund, a similar investment that owns corporate stocks. So we have ordinary and qualified dividends, we have non-taxable distributions, and we have capital gain distributions. So whenever this is issued, it is going to be reported on form 1099 DIV. So ordinary dividends, they're the most common type of corporate distribution, and they're paid from the earnings and profits of the corporation. Ordinary dividends, they're also qualifying dividends if they meet certain rules. And what the rule is that it needs to be held for a certain amount of time, generally 60 days, and that the dividend is issued by a U.S. corporation. If the ordinary dividends, if they're not qualified dividends, what it basically means is ordinary dividends, they are taxed at your ordinary income tax rate. Qualifying dividends, instead, they are taxed at the long-term capital gains rate, and based on your income, it'll be subjected to either 0%, 15%, or 20% taxes. So with that being said, qualified dividends are taxed at a preferential rate and are a subset of ordinary dividends. This seems correct, but we'll go through the rest. B states there is no distinction, and this is not true, so B is incorrect. C states qualified dividends are excluded from gross income. Absolutely not. This is incorrect. And the last one says ordinary dividends are taxed at a preferential rate. D is also incorrect. So the correct answer is A. Qualified dividends are taxed at preferential rates, and they are a subset of ordinary dividends. So again, the key thing to keep in mind, ordinary dividends are subjected to your ordinary income tax rates, and qualified dividends are qualified to be taxed at preferential rates, which is similar to long-term capital gains. All right, so this brings us to our last few questions. This is just, along the same lines of dividend income. So here it's asking, respond to the following. In 2024, how are qualified dividends taxed? As we mentioned earlier, qualified dividends are taxed at preferential tax rates similar to capital gains. So qualified dividends, they're taxed at either 0 or 15%. No. 10 or 15. No. The correct answer is based on your income, it'll either be subjected to 0%, 15%, or 20%. So part B states, complete the following paragraph that outlines the tax rates and application for qualifying dividends. So this is as of 2024. This is generally indexed for inflation. So in the event, if a single taxpayer has taxable income of $47,025 or below, capital gains is taxed at $0, right? So keep in mind, this also includes the dividends, right? So the dividends is also included in the income and calculated as $47,025. Here it states, if that same single taxpayer, if their income was over $47,025, because obviously that's the threshold for it to be taxed at 0, and up to $518,900. So what Uncle Sam does is he casts this very large net, right? So the minimum is $47,025, and then the ceiling for that is $518,900. So most people, they fall within that rate. So Uncle Sam is getting something. So in this case, they get 15%. Here it says, and if that taxpayer made over, obviously we know the ceiling for the 15% is 518,000. So if that taxpayer made over 518,900, capital gains is going to be taxed at 20%. So just something to keep in mind. And then lastly, depending on an individual's income, right? Certain high income taxpayers, they also need to pay an additional 3.8% in Medicare tax on their net investment income. So sometimes, an often complaint is you'll hear the wealthy, they don't pay a lot of taxes and stuff like that. They have what's called alternative minimum tax. They have this net investment income tax, and they also have additional Medicare tax. So there are additional taxes that wealthy taxpayers are subjected to. All right, so We have about 2 more questions left. Here it states Kelly receives a $40,000 scholarship to Ivy University. She uses $35,000 on tuition and books and $5,000 for rent while at school. How much is going to be subjected to taxation? So again, once you receive a scholarship, any amount that's spent on tuition and books and qualified educational expenses, those are considered tax-free. Rent, room, and board, however, is going to be subjected to taxes. So therefore, if we do simple math, or we don't even need to do the math actually, because it tells us here, it breaks it out. She received 40,000, 35,000 went to tuition and books. That remaining 5,000 spent on rent is considered taxable income. Here we see, based on this information, Alicia's gross income for 2024 is, it states Alicia loses her job partway through 2024. Her employer paid her wages of $15,450 up through her date of termination. After that, she received $1,600 of unemployment compensation from the state until she started a new job for which she is paid wages of $1,400 through the year. So it's asking us, what is Alicia's gross income? So this is taking us back full circle. Gross income is income from all sources, whatever derived. So we start off and we see the employer paid her wages of $15,450. That's included in income. It also says that she received $1,600 of unemployment. Uncle Sam says you weren't working. You received money. In such case, unemployment income is considered income. And there was like, I think it was like maybe 2021 and 2022 where there was a special provision. This was like during COVID, where a lot of people lost their job. And at the federal level, they excluded up to $10,200 of unemployment income. Certain states, they adhered, they conformed to what the federal level was doing. Like I'm from New York. New York said, for clients in New York, so they would get a $10,200 deduction at the federal level, but for the state, you had to add back that $10,200. So not all states conform to what the federal level did. That's the only time I've ever seen an exception. But yeah, so sometimes there are exceptions, there are exclusions for a specific tax year based on the situation. So something to keep in mind. So we added the wages plus the unemployment income plus the income that she earned from the job. So therefore, Alicia is going to report $18,450 of income. All right, so this brings us to our last question, Social Security benefits. So the question states for 2024, the maximum percentage of Social Security benefits that could be included in a taxpayer's gross income is. So one thing we'll come to learn is that many taxpayers, they can exclude all of their Social Security benefits from gross income. But if the individual has other sources of income, generally they might have to include a percentage of their benefits in gross income. So there's a specific formula that's put in place to help to determine how much of Social Security is going to be taxable. And again, this is a great opportunity for tax planning and projection. Let's say someone is also Social Security, they'll come to you and say, hey, I'm considering getting a job. If I get a job, what is going to be the implication on the taxability of my Social Security benefits? So depending on your income, it can either be taxed at 0%, 50%, or 85%, which is the maximum. So 0, 50, and 85%. So this brings us to the end of chapter 2, gross income and exclusion. So again, the key definition for gross income is all income from whatever source derived. And unless there is a specific exclusion in the tax law, let's say it needs to be considered in taxable income.